Welcome to the Personal CFO. Today I'm going to be talking about a recent headline and a recent chart that talks about 3 different ways to earn 5% in the market. Now, why 5%? Well, because that's just what the chart is giving us, and it'll give us some context for, I think, making better long-term decisions. Okay, so here's the chart. And as you can see, based on the identifiers, the top line is the S&P 500. The middle line is investment-grade corporate bonds. What does that mean? It means high-quality bonds. And then the bottom line is 3-month Treasury bills. So what a lot of people call the risk-free rate. And as you can see, typically over the last decades, the S&P 500 earnings yield, which means your expected rate of return from the S&P 500, has been higher than the other 2 lines. And then you have your investment-grade corporates in the middle, and then you have your short-term Treasury bonds at the bottom. Why is that? Well, it would make sense that if you're going to be investing in the stock market and accept big returns up, big returns down, a lot of volatility and a lot of uncertainty, you will want a higher rate of return from that investment. Correspondingly, if you go to the middle line, investment-grade bonds, they're less risky, have less volatility than the S&P 500, so you're willing to accept a lesser rate of return. And then with 3-month treasuries, essentially this is referred to as the risk-free investment because the treasury can just print more money, so you don't really have to worry about not getting your money back. And so you've kind of got these 3 lines that are representative of risk. Well, what's happened lately that's never happened before? Well, instead of this hierarchy of risk, where you have one and then the other, clearly separated, they've all converged around 5%. So what does that mean? It means that right now, you can get roughly the same rate of return investing in short-term treasuries, which are air quote risk-free, investing in investment-grade bonds, and the projection for the return of the S&P 500 is all around 5%, roughly 5.3%. So as long-term investors, what does this mean for us? Well, I think what it means is, that we need to really understand what we own and why we own it. And when you look at the 3-month Treasury bill, it's pretty attractive. You think, I don't have to take any real risk here other than it's a short-term investment. And so if rates start going down, you're not locked in for a long period of time. You might have to reinvest, and the interest rates are lower. You have to reinvest at a lower rate. That's really the risk there. But from the standpoint of losing your money, not that much risk when you're investing with the U.S. government. With your investment-grade bonds, you think, okay, anything can happen to any one company, but why would I take a risk of default of a company when I can get the same rate of return from treasuries? Well, the reason you might consider investment-grade bonds is while this is short-term, if you look longer-term and you want to buy longer-term bonds like 10 and 20 years, corporate bonds actually give you a higher rate of return than U.S. Treasuries. U.S. Treasuries, as you get into 10 and 20 years, are, roughly 4%, corporate bonds are roughly 5%. So you get a little bit higher rate of return, but you're also taking the risk there that anything can happen to any company and you could be in default. And so then you go to the S&P 500. And this is where I want to pull this apart a little bit and say, okay, if the S&P 500 has an expected earnings yield of 5%, and again, I've done a video on earnings yield before, essentially it is the inverse of price to earnings, which people have seen before. So price to earnings ratio means what am I paying for every dollar in earnings of a company? So the S&P 500, if you have a 5 earnings yield, means you have a 20 price to earnings. So for every dollar, I'm paying $20, right? For every dollar in earnings, I'm paying $20 for the stock. Okay, so 5 is not great. Well, the good news is, the publicly traded markets in the U.S. and international, the S&P 500 is not your only option. And while the S&P 500 has an earnings yield of roughly the same as a risk-free treasury, it doesn't give you a whole lot of incentive to invest in the S&P 500, there are a lot of other options with much higher earnings yield, double and then some, relative to the S&P 500. And so it's important to understand when you're dealing with stocks, not all stocks from a price standpoint and an expected return standpoint are created equal. And so when you look at these kind of headlines and you see these lines converging on each other, it's important to understand, where am I here? Am I taking risk that I'm not getting compensated for? Okay? Or do I look at this line and say, is my portfolio built to where I need to be looking elsewhere if I'm going to move that line up to achieve a higher rate of return, given I'm going to be accepting the volatility that comes along with the market? I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.